Hi everyone and welcome to chapter 15. In this chapter we are going to discuss about options on stock indices and currencies. So before we start with the PowerPoint, so let us go through the Excel and understand and do some problems based on that, and then we'll come back to the PowerPoint and cover it. Okay. So the biggest difference, we have discussed options on stocks before, we have discussed options on bond before, but difference between stock options and index options is, the biggest difference is index options have dividend yield. More often than not, most index options pay some dividend. Okay. Now before we go through that dividend yield, what are index options? Indexes are group of stocks. These are group of stocks. Okay. Example will be in Canada. If you see SAP Standards and Poor Composite, right, that has around 240 stocks. Then you have TSX 60 that has 60 stocks, top 60 companies. In America you have SAP 500 that has 500 stocks, and let's say NASDAQ 100 that has 100 stocks. Okay, so index is a group of stocks. It's a portfolio that is a group of stocks. Examples: Canadian TSX Composite or TSX 60, SAP 500, NASDAQ in United States. Now, since they are group of stocks, they generally pay dividend, but you cannot estimate the exact dividend that they would pay. But generally, you can estimate the dividend yield that the index has. Now, what is dividend yield? It is dividends as percentage of price. Dividends as percentage of price. Okay, so it is dividends, the returns that you're going to get from dividends in percentage form. Now most of the times when we use dividend yield, it has to be continuously compounded. Okay, it has to be continuously compounded and in annual form. It has to be continuously compounded and it has to be in annual terms. Okay, so the problems that we are going to do, we are going to assume that it is continuously compounded, and if it is not given in annual terms, we'll convert it to annual terms. So when you price options, when you do things about index options, you have to include dividends in the calculations. So all the calculations that we have done till now, we have done, let's say, lower bounds, upper bounds of options. We have done option pricing using Black-Scholes model. We have done option pricing using binomial trees. In all these calculations, you have to modify the formula to include dividend yield. Now, how does dividend impact a stock? Whenever dividends are paid, when dividends are declared and stock becomes X dividend, that is, it includes the dividend in its price, the stock price goes down. So important point, when dividends are paid, the stock price goes down. So because of dividend, the stock price goes down. Now options are based on stock prices. So if stock price is going down, then the S0, that is the present value of stock, right, it also goes down. So you have to discount the stock price by the amount of dividend paid. So this is the overall theme that we are going to work with. We are going to discount the stock price by the amount of dividend paid. So before we go to that, index options are mostly used for hedging. So if you're a portfolio manager and you have a portfolio, so let's say you have a portfolio of 500,000 and you're afraid of the portfolio going down, then you use index options to hedge your risk. Now how do we hedge that risk? We hedge that risk by using put options. So portfolio managers generally buy put options to protect from fall of value. Now when you are using put options, now you need to wonder what strike price to choose, which strike price, because index options are available on different strike prices. Let's say SAP 500 is 3600. So you get strike prices in a wide range, like 3300, let's say 3300, 3400, 3600, 3700, etc. So you can buy put options of different strike prices. Now which strike price to choose, that's a big question. So we are going to answer that. Okay. So how do we decide which strike price to choose? So we so let us assume the index base. So I'm going to do some calculations, explain it, and then we'll come back to this question of which strike price to choose. So let's say index value is $1,000 right now. Index is 3-month, index in 3-month values are estimated. So it can be a wide range. It can go down to 880 and it can go up to 1080. So it can go down to 880 or it can go up to 1080. Now we have to find out what would be the portfolio value if index changes. So if the market changes, right, index is market. So if market changes, what would be the portfolio value? So let us assume the base portfolio value that we have is 500,000. We are starting with 500,000. So if index goes to 1080, what would be the returns on your portfolio? Now how to calculate that? Now returns on your portfolio are calculated using CAPM model, capital asset pricing model. So capital asset pricing model, the formula is risk-free rate plus beta of the portfolio into return on market minus risk-free. So this gives you portfolio return. So let us assume some stuff. So risk-free rate in the market is 4%. Beta on the portfolio is 1.2. Okay. And return on the market we have to calculate. Okay. So I am going to add one more column to this because return on the market we don't know. Return on market is return on the index. But we know the index base value was 1000 and index in 3 months. These are the different formulas. These are the different values. So how do you find return on the index? Return on the index is index in 3 months divided by starting value base price minus 1. Okay. So index is going 8% up in the first case. So how much will portfolio go up or go down? So it will be 3%, 4% risk-free rate RF plus beta 1.2 times return on market, that is 8% we calculated, minus risk-free rate 4%. So if market, that is index, goes up by 8%, portfolio will go up by 8.80%. So portfolio value will become 500,000, the base value, into 1 plus 8.8. So if index goes up, portfolio goes up, and if index goes up to 1080, portfolio will be going up to 54440, right? Similarly, we'll calculate returns for different index levels. Then we'll calculate returns for portfolio and we'll then have portfolio values. So, and then we'll come back to the question which strike price to choose. So let's do that. So this divided by 1000, this divided by 1000 base value minus 1, this is portfolio return. Okay, return on stock will be 4% plus 1.2 into, yeah, so portfolio value will be this. I'll just drag this down and I'll drag this down. Okay, so let us assume you are a portfolio manager of managing $500,000 right now in portfolio value, and you do not want your portfolio to go down by more than 496,000. So you don't want to lose more than 4,000 bucks. So which put option would you choose? You will choose a put option of strike price 1000. You will choose put option of strike price 1000. Now how many put options would you choose? That is given by beta into size of portfolio divided by size of option contract. So I'll calculate that too, and then we'll do one more problem, right, in its entirety. So beta is 1.2 for the portfolio into size of portfolio, you're managing 500,000, right, divided by size of option contract. So size of option contract is strike price, okay, index strike price into 100, because options are generally traded in contract values of 100. So you would have to buy 6 contracts, 6 put contracts. You would have to buy 6 put contracts to hedge your portfolio. And which strike price you will choose? You will choose strike price of $1,000, so that you cannot lose, you do not lose more than $496,000. So your portfolio value would not go down below this value, because if it goes down below this value, the put contracts would kick in and you will get returns from put that would offset your loss. Okay, so let's do one more problem. So let's say you are handling a portfolio of 800,000. Okay, that portfolio has a beta of 1.4. Portfolio has a beta of 1.4. Then risk-free rate is given 4%. Okay, risk-free rate is given 4%. Then following things are given. You're trying to hedge it with S&P 500. So index is S&P 500. The current base value is 3600. That's the price right now. Now you are hedging it for 4 months, and following index values are given. So index values given are, let's say 3600 comes in here, then 3700, then 3800 and 3900, and same way this minus 100. So following strike prices are available for put options. Okay, now which strike price should I choose? Which strike price should I choose so that my loss is, so my portfolio value does not go below 700,000. I'm okay till 700,000, but I do not want my portfolio value to be below 700,000. Now how do you do that? So steps for that. First, find out returns on market. Then find out returns on portfolio. Okay. Then find out portfolio value. And we'll choose a strike price that corresponds to 700,000 portfolio value. So let's do that. Returns on market will be 3900 divided by 3600, the base price, minus 1. So 8.33%. I'll drag this down so you get returns. So 8520, 2.78, 5, etc. Returns on portfolio will be risk-free rate 4% into beta 1.4 times return on market, that is 8.33, minus risk-free rate. Okay, risk-free rate, not times, it should be plus. Risk-free rate plus beta into return on market minus risk-free. So portfolio returns will be 10% and whatever you get. Portfolio value will be 800,000 is the base price, base value, into 1 plus portfolio returns. Okay. Now which strike price we want to choose? We want to choose a strike price so that we do not lose more than 700,000. So closest value to that will be this one, 693. Closest value to that will be 693. So you would choose, because you don't want to lose not more than 700,000. So 724 and 693. So somewhere in between these two strike prices. So if let's say strike price of 3350 is available, something in between 3400 and 3300, you would ideally choose that. Okay. Now how many contracts do you want to buy? Let's say you select this strike price. How many contracts you need to buy so that you hedge? So how to calculate that? So that is beta into portfolio size 800,000 divided by option size. So strike price into 100, because options are traded in contracts of 100. So 3.39. So 3.39 put contracts you need to buy. It's almost 4 put contracts you need to buy to hedge your risk. Okay, so this is the basic use of put options to hedge your risk. Now, okay, so let's continue. Now we have discussed which strike price to choose, which put options to choose. Now we are going to look at valuations of call options and put options. So whatever we have discussed in previous sections, we are going to revise those formulas in which we include dividend. So let's start. So when dividends are paid, the price of the stock goes down. So whatever stock price is there, in formulas that we have already discussed in previous modules, whenever you see S0, you have to substitute that S0 by S0 multiplied by E minus QT. Why do we do that? Because stock price is going to go down. So you have to discount S0 by the dividend yield. You have to discount S0 by the dividend yield. So we have discussed lower bounds of call options. So lower bound of call option, lower bound of call option. So call option should be at least or more than maximum of S0E minus QT. So the original formula was S0 minus K e to the power R by T. So instead of S0, we are going to substitute S0E minus QT. So lower bound of call options becomes maximum of S0E minus QT minus K is the exercise price, E minus RT. So you discount exercise price by risk-free rate, you discount stocks by dividend yield, and you find the lower bound. Lower bounds for put becomes K E minus RT, that is exercise price or strike price discounted by risk-free rate, minus S0 E minus QT. Okay. Same way we have to substitute put call parity too. So C plus K minus R to the power T, right? This was already there. So call plus bond, present value of bond discounted at risk-free rate, equals to put plus stock. Now instead of S0, we are going to substitute S0 E minus QT. So all the formulas for lower bound for call, lower bound for put call parity, everything changes. Okay. Then Q is okay. Now based on put call parity, sometimes you may have to find dividend yield. So in that case, dividend yield is given by dividend yield Q equals to 1 by T, 1 by time frame, natural log of C minus P plus K to the power E minus RT. So discounted value divided by S0. So this is the formula to find dividend yield if dividend yield is not given but call and put prices are given. Okay. Same way Black-Scholes-Merton model also changes, the BSM model also changes. So call formula, instead of S0 you put S0 E minus Q by T, right? Input formula also, instead of S0 you put S0 E minus Q by T, Q into T, right? And also D1 and D2 changes. So D1 formula becomes natural log S0 by K plus R minus Q. This minus Q is new, right? Plus sigma square by 2 T, and D2 becomes natural log S0 K plus R minus Q minus sigma square by 2 times T sigma divided by sigma root T. Okay. So these are all index option formula changes that you have to do. So let's solve some problems and try and understand, right, how to use these formulas. So I'm going to copy all these formulas on a new Excel sheet. Okay. And we'll do some problems based on that. Okay. Put call BSM did not copy. So let's do one by one. So this was the basic concept. Instead of S0, you replace it by S0 E minus to the power minus Q by T. So let's do some problems for calculating lower bounds of calls and put, and calculate using put call parity. Okay, so let's do that. So assume you're given a question, calculate lower bound of call when following details are given. Stock price is given. Okay, stock S0 is index price generally. So let's do it on SAP 500. So 3600 is the index price right now. Okay, K is the exercise price. So let's say 3500 is the exercise price. Okay, then dividend yield of SAP 500 is 1.5%. Okay, risk free rate is given to be 4%. And for simplicity, let's take 1 year options. Time is 1. Now what will be the lower bound of call option? So lower bound of call option you will calculate using max function. Okay, so first column is S0 E minus Q by T minus K E minus R by T. So stock price, so I'll zoom in a bit so that you can see it. So it will be max function, maximum of, I'm adding one more bracket so that we can solve this whole thing. S0 is stock price, so 3600 is the index price, so current spot price, multiplied by exponential, okay, minus negative sign dividend yield 1.5% times T is 1. Okay, this is the first thing, and you have to subtract K is 3500, so I'll open one more bracket, 3500, okay, into exponential negative sign risk free rate 4% times T is 1. Now this was the first bracket. You also have to add 0. So it is max of this thing comma 0. Now we have not closed the brackets properly, that's why it's showing this. I think this should work. Max of 3600 into exponential minus into 1. So this is the first bracket. Okay, minus 3500 into exponential minus 4% star 1. So I think only formula is exponential. Okay, that's why it's happening, because the brackets were wrong. So lower bound of call option, I have just put it in the formula. You have to be careful about the brackets. So lower bound of call option is 183. Now let's calculate lower bound of put option. So let us say we are doing it again on index. We are calculating lower bound of put options now. So for fun purpose, I'll just change exercise price. Current price is 3600. I have changed this price to 3700. So you're buying a put of 3700. So what is the lower bound, lower limit of that? So how to do it? So we are doing it for put now. So we'll put everything in the formula. So equals to max. Okay. K is 3700, exercise price is 3700, times exponential, okay, negative risk-free rate 4% times 1. Time is 1. Okay, minus S0, that is 3600 stock price, into exponential negative sign dividend yield 1.5% times 1. Okay, and comma 0. So put price will be $8. Put price will be $8. So 3700 K exponential minus 4 times 1 minus 3600 times exponential negative to the power 1.5% times 1 comma 0, and this is 3600 exponential minus 3500 exponential. Yeah, I was just checking if the answers are right. So this is how you do lower bounds and upper bounds for call options. Now sometimes they may ask you to do put call parity. So let us say they are asking you, so you have to just put stuff in this formula. They may ask you to calculate call price, they may ask you to calculate put price. So let us say put price is known, put is this one, okay, stock price we know, S0 is 3600, then K is known, K is 3700, then R is risk-free rate 4%, and Q is dividend yield, that is, let's say 1.5%. Now using put call parity, let us say they are asking you to calculate call price. So based on this formula, if you rearrange, call becomes call, if you have to transfer this here, so call is equals to put plus S0 into E minus Q by T, and this is plus here, so when it goes here it becomes minus. So call price will be put price is $8.51, 8.52 plus stock price is spot price 3600 into exponential discounted minus QT. So Q is dividend yield, so 1.5% times T 1. Okay, so this was the second bracket, and again this goes there, it becomes minus exercise price 3700 times exponential negative sign risk-free rate 4% times 1. Okay, so call price should be 0.021. Whatever call price you're getting, that's the price. Okay. Now, sometimes they may ask you to find the dividend yield that is assumed because of calls and put prices. So let us say call price is given to you. Call price is 10. Put price is known to you. Put price is 8. Okay. K is exercise price. So that is 3,500. And let's make it 15. As it will already be in profit of 100, so let's make it 115. Okay, so call price is 115, put price is 8, K is exercise price 3600, stock price is 3500, and stock price is 36. So index price right now is 36. Dividend yield is what we have to calculate. Risk free rate is given to you. Risk free rate is 4%. So you can use this formula to calculate the assumed dividend yield. How to do that? So it is 1 by T. So 1 by 1. Let's say time is 1. Time is 1. So it will be 1 by 1. So we can ignore it. Natural log. Okay. C, that is call option, 115 minus P. P is 8. Okay, plus K 3500 times exponential minus 4% into T divided by S0. What is S0? 3600. So put it in the formula. So call dividend yield is 3%. Dividend yield is almost 3 point. So if you take it in percentage, it is 3.68%. It is 3.68%. So if you're given other parameters, you can calculate the assumed dividend yield in the index. Okay. The next is Black-Scholes-Merton model. The changes that you have to do to Black-Scholes-Merton model. Now, as we remember from last class, Black-Scholes-Merton model are used to calculate call and put premiums or prices. Calls and put premiums. So what I'm going to do is zoom out. Keep this here. We'll write down steps for call and steps for put. And then we'll solve some problems. So step 1 for call is calculate D1. Then in step 1 we also calculate D2. So D1 is this formula, D2 is this formula. Then step 2 we calculate N D1, normal distribution of D1, and N D2. Okay, and step 3 we calculate call option price using call option formula. For puts, it is step 1 you calculate D1 and D2 using the same formulas. Step 2 you calculate N D1, N minus D1 and N minus D2. And step 3 you calculate put option price using put option formulas. So let's try and do few problems. So few things are given to you. So S0 is known for the index 3600. Then let's say K is known for the index 3500. R is known, risk-free rate, that is 4%. Q is known, that is dividend yield 1.5%. Then sigma, volatility of index is known, 15%, and time, for simplicity, let us say it's a 1 year option. In exam it may not be a 1 year option. Okay, so all this is given. You have to calculate call and put prices. So I'll just move it here. Okay, let's do call first. So step 1 in call, calculate D1. So D1 is using this formula. So D1 is natural log, okay, S0 by K. So S0 is 3600, K is 3500. I'm putting that, plus R minus Q. R is risk-free rate 4%, minus Q is 1.5%, and again plus sigma square, so 15% squared by 2, and times T, that is 1. So this was numerator, natural log of S0 by K, so 3600 by 3500, plus 4% minus 1.5% plus 15% to the power 2 divided by 2 times 1, and you divide this by sigma root of T. So sigma is 15% and square root of T, T will be 1. So ND1 is 42%. Let's calculate D2. So I'll drag the formula down because D2 is extremely similar, except you, instead of adding sigma square, you subtract sigma square. So instead of adding sigma square by 2, you subtract sigma square by 2. Rest of the formula is exactly same. Okay, so D1 is 42 plus 0.42, D2 is 0.27. So we have to calculate normal distribution of D1 and normal distribution of D2. Okay, so we have all we need to use in this function. So we'll use this function to calculate call price. So how to do that? S0 is 3600 multiplied by exponential, okay, dividend yield, so negative, divided 1.5% times 1 times T, and multiply this again by, so let's put this in the bracket because we have to then subtract 2. Multiply this again by ND1. So ND1 is this one. Okay, subtracted by S by K. Okay, so K is 3500 times exponential, negative sign, risk-free rate 4% times T, 1, multiplied by ND2. Okay, so the call premium, the call price will be $311. Call price will be $311. Now let us do the same thing for a put option. So for put option, the first step remains same. So you calculate D1 and D2. Then step 2 changes. You calculate N minus D1 and N minus D2. So this becomes normal distribution, negative sign, D1, okay, and negative sign D2. So negative, negative. Now we'll use put formula, we'll use put function to calculate put price. So if you use put function, it will be K. K is 3500 times, so I'll put it in the bracket so that we don't go wrong, 3500, okay, times exponential risk-free rate 4%, risk-free rate 4% into 1, risk-free rate 4% into 1, and multiplied by n minus d2. So n minus d2. Subtract this by S0. S0 is 3600, okay, times exponential Q. Q is 1.5% times 1, okay, and multiply again by n minus d1. So put everything in. Put price is $127. Put price will be $127. So this is how you change the formula for lower bounds of call, lower bounds of put call parity, dividend yield, and Black-Scholes-Merton model to include dividends. So this applies on any index because indexes always have dividend yield, or it also applies to stocks because some stocks also pay dividends. So anything that pays dividend, you can use this approach. Okay. So next is options on currency. Now whenever you deal with currencies, you also have to worry about risk-free rate. You have to worry about risk-free rates. Okay. Now there are two risk-free rates in terms of currencies. So R is risk-free rate in domestic market, that is US based risk-free rate generally, and RF is risk-free rate in foreign market. So that's a risk-free rate in Canada because we are currently located in Canada. So you have to consider risk-free rates in domestic market and risk-free rates in foreign markets. So what you have to do is you have to discount S0, right? You have to discount S0 wherever you see S0 by risk-free rate of foreign market. Wherever you see S0, you have to discount it by risk-free rate of foreign market. So Black-Scholes-Merton model for currency, I'll explain it, then we'll solve one problem. So for call and put. So Black-Scholes-Merton model is the current exchange rate multiplied by e to the power risk-free rate in foreign currency in times t, ND1 minus k e to the power risk-free rate in domestic currency into ND2. Put is similar, right? Where D1 is natural log of S0 by k plus R minus risk-free rate plus, so the difference is we subtract risk-free rate from the normal Black-Scholes model, plus sigma square by 2 t divided by sigma root of t, and you subtract it when you calculate D2. Okay, so that is forward. So let's copy this and do one problem based on that. So for currency, this is the model that we are going to follow. Now what are the steps? Steps are same for calls and puts. So I'll copy that. So calls, calculate D1, D2, ND1, ND2 and use call formula. For puts, it is calculate D1, D2, N minus D1, N minus D2 and use put function. So let's do it. So few details are given to you. Current exchange rate is 0.7. Okay. So 1 US dollar is 1 Canadian dollar is 1 US dollar is 0.7 Canadian dollars. Then exercise price is, let's say, 0.71. Okay, exercise price is 0.71. R is given, risk free rate in American dollars 3%. RF is known, risk free rate in Canadian dollars 4%. Okay, and time, let us assume it's 1. Time is 1. Currencies don't pay dividend, but they have different risk free rates. Now how do you adjust, how do you calculate Black-Scholes-Merton model using this formula? So we'll follow the steps. So calculate it for call and put. So let's do call first and then find a put. So for call, step 1, always calculate D1. Now what is D1? D1 is natural log S0, that is 0.7 divided by 0.71. So S0 by K. Okay, plus risk free rate. The risk free rate is 3%. R is 3% minus RF 4%. So R minus RF plus sigma square. So let's say volatility is, I forgot the volatility. Volatility is, let's say, volatility of currencies is generally lower. So volatility is 6%. So now let's do it again. So it will be natural log S0 by K. So 0.7 divided by 0.71 plus R. R is 3% minus RF 4% plus sigma square. Sigma square is 6% to the power 2. Sigma square is 6% to the power 2 divide by 2, because it is 6% to the power 2 divided by 2 times T. T is 1. And this thing divided by sigma 6% into square root of T, square root of 1. So ln 0.7 divided by 0.71 is 0 by 1. 3% minus 4% R minus RF plus sigma 6% squared divided by 2 times 1 divided by 6% into square root of 1. So this was D1. Now D2 I can just drag it down and change addition of sigma to subtraction of sigma. We can change addition of sigma to subtraction of sigma, because instead of adding it gets subtracted. Rest is same. So we know D1, we know D2. We have to calculate normal distribution, okay, of D1. Normal distribution of D1 yeah, and normal distribution of D2, and then we'll use call function. So call function is S0. S0 is stock price, so 0.7 multiplied by exponential risk-free rate minus risk-free rate in foreign market 4% times 1 into ND1, okay, minus K, that is 0.71 times exponential negative sign risk-free rate in domestic market times 1 times T into ND2. So Call option will trade at 0.09367. It will trade at 0.09367. Same way you can calculate put option prices. So for put, let's do it for put. The first step is same. You calculate D1 and D2, right? You calculate D1 and D2. Then instead of ND1 and ND2, you have to calculate N minus D1 and N minus D2. So I'll do that. I'll just copy this formula and change it to minus D1. Okay. Now we use the put function. So put function is K. So 0.71 times exponential risk-free rate in domestic market. So minus 3%, R is 3% times 1 into N minus D2. Okay. Subtracted by S0. S0 is 0.7 times exponential negative sign 4% risk free rate times T, okay, multiplied by N minus T1. So put option price is 0.025831. So call we calculated, put we calculated. So whenever currencies are there, you have to include risk-free rate in foreign market. Now this we are going to cover more in the next class, but sometimes you have to calculate options on forward. You have to calculate options on forward contracts. Now how to calculate options on forward contract? So we know forward price is equal to stock price S0 E R minus Q, where Q is dividend yield, R minus Q times T. So we substitute this as F0. So D1 becomes ln F0 by K plus sigma square T by divided by 2 and sigma square root of T. D2 becomes D1 minus sigma square root of T. So we calculate D1, D2. We calculate ND1, ND2 or N minus T1 minus T2, and we use this formula to calculate call price and this formula to calculate put price. So we'll discuss more on that in the next thing. So this is options on forwards and futures that pay dividend. So maybe it is on a forward on an index or it is on a forward on a stock. Now same way we can calculate options on currency forwards and futures. So we know F0 is S0 E R minus RF into T. We discussed this calculation of forward prices on currency. Then we change the formula. We calculate D1 using this formula, T2 using this formula, ND1, ND2 or N minus T1 minus T2. We use the call formula to calculate call premiums and put formula to calculate put premiums. Okay, so let's go back to the slides and cover the chapter. So the most popular indexes underlying the options in US are S&P 100, right? OEX or XEO. These are the codes that Chicago exchange is where options are traded. In Canada, they are traded on Montreal, right? S&P 500, SPX is also famous. Most of the times SPX 500 is used, S&P 500 is used. Dow Jones Index is used, DJX. Nasdaq is NDX. So these are the codes. These are the famous indices on which options are traded. Contracts are generally 100 times the index. They are settled in cash. OEX is American and XEO is European. Okay. So index option example, consider a call option on an index with a strike price of 1260. Suppose one contract is exercised when the index level is 1280. What is the payoff? So it's a call option. So call option is always index price 1280 minus exercise price into 100, because 100 is the multiple. So the answer will be 1280 minus 1260 times 100. If it was a put, it was other way around. It will be strike price minus index level into 100. So using index option for portfolio insurance, we have discussed we use put option. So suppose the value of index is S0 and strike price is K. If a portfolio has a beta of 1 and the portfolio insurance is obtained by buying one put option, so they have given appropriate insurance level. Example, they have considered portfolio beta is 1, index is 500,000, index currently stand. So portfolio is 500,000, index is 1000. You want to insure against portfolio falling below 450. So we did that. How to do that? We calculate various index levels and see which strike price corresponds to loss of 450. So Excel problem. Portfolio has beta of 2, its current worth is 500 and index is 1000, risk-free rate 4%, dividend yield 4%, the risk-free rate 12%, dividend yield is 4%. How many put options to purchase? So they have tried to solve it. If index rises, right, the returns on the portfolio is given by risk-free rate plus risk-free rate plus beta into risk-free return on market minus risk-free. So these things are given. You can calculate portfolio value. So it will look something like this. So you have to choose a strike price that corresponds to 450 or close to that. So 960 is the strike price that will protect against portfolio falling below 450. Currency options are traded on Nasdaq, OMX. There are also exist an active over-the-counter OTC market. Most of the times currency options are OTC contracts, over-the-counter options, right? Currency means exchange traded options are rarely used. Currency options are used by corporations to buy insurance when they have an FX exposure. Have the effect of range forward contracts is where you buy calls and where you buy call, sell put, or you buy put, sell call. So it's to hedge your foreign exposure. So they have an effect of ensuring that the exchange rate paid or received will lie within a certain range. When the currency is to be paid, it involves selling a put with strike price K1 and buying a call with strike price K2. So K1 is less than K2. So you sell a put of K1, buy a call of K2. So your exchange rate exposure will be within a certain range. When currency is to be received, it involves buying a put with K1 and selling a call with K2. So opposite of that. So you buy a put option with K1 strike price and you sell a call option with K2 strike price. Normally the price of put equals price of calls so that the exposure is 0. So this is how the payoff looks. So if it is below K1, so you can either take short position or long position. So short position was the first one where you sell a put with K1 and buy a call with K2 and vice versa. So depend on that, your payoffs will depend. So bottom line is, if you are receiving some if you're paying some currency out, you're paying foreign dollars, then use this approach, sell a put with K1 and buy a call with K2. K2 is greater than K1 always. And if you're receiving some foreign dollars, use this approach, buy a put with K1 and sell a call with K2. K2 is more than K1, right? So this is how you hedge your currency exposure. When we get the probability distributions of stock at time t, stock starts at S0 and dividend yield is Q. The stock starts at S0 and provides no income. So what does it mean? That whenever dividends are paid, you have to discount S0 and then include it in your formula. We can value European options by reducing the stock price to S0 E minus Q by T and then behaving as though there is no dividend. So formulas for lower bound of call becomes lower bound of call S0, difference is you discount it by dividends. Put becomes S0, again discounted by dividend. Put call parity, call plus bond discounted at risk free rate equals to put plus stock discounted at dividend yield. Now Black-Scholes-Merton model also you have to change. So we have done some problems on that. Basically you have to subtract Q here in D1 and D2, and then discount stocks by dividend yield, discount stock price by dividend yield. We can use the formula for an option on buy on stock paying a continuous dividend yield. S0 is index level, Q is the average dividend yield expected in the life of option. So same way you can have options on forward prices, right, on forward contracts of index. So in that case, first find out F0. F0 is equals to S0 E R minus Q times T, and then use this approach. Calculate D1, calculate D2, calculate ND1, ND2, or N minus D2 minus D1 depending on call or put, and use call function to find out call price, put function to find out put price. Now sometimes they may ask you to calculate implied dividend yield. So this is the formula for that. We have solved one example based on that. For European calls and put with strike price and time to maturity, implied dividend yield is calculated using this function. These formulas allows term structure of dividend yield to be OTC. European options are typically valued using forward prices. American options require dividend yield structure. We denote the foreign. Okay, now currency options have major difference that there is two risk-free rates. Risk-free rate in domestic dollars and risk-free rate in foreign currency. So returns measured in domestic currency for investing in foreign currencies RF times the value of investment. So same thing, we can use formula. Dividend yield we can set F to risk-free rate, and changes that we have to make is this. So subtract RF here in D1 and D2 and discount stock by RF. Using forwards and future exchange rates. So if you're calculating an option on currency forwards or currency futures, then you first calculate F0 as 0 E R minus RF times T, then calculate D1, D2, call and put. Now American options cannot be priced by Black-Scholes Merton model, especially American put options. So in that case, you can use binomial trees to do that. So everything remains the same, only formula for A changes. So we have solved binomial trees questions in the previous chapter. So if it is paying dividend or it is providing risk-free rate, right, it is a foreign currency based derivative, then A becomes, so we have to calculate P, U, D and use the function to calculate. You draw the tree and solve the tree. So steps are that. So formula for A changes. So you have to subtract Q from R, and formula for A for currencies is you have to subtract risk-free rate from R. Rest of the process remains same. So that's it for this chapter. See you in the next.